to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. We are glad that you can join us today. What has been happening in the markets? Well, big leadership changes globally. The big one, I think you will all agree, was in China, where Xi Jinping managed to cement another 5 years on top of the 10 that he's had already as Secretary General of the China Communist Party, which is the most powerful position in the country. The presidency that follows is really just a formality after that. The other big leadership change was Rishi Sunak. Congratulations to Rishi, ex-Goldman Sachs. I'm sure he's got a much better handle on economic policy than Liz Truss has. And it's really fantastic that there's someone of colour who's the Prime Minister now of England, also the youngest Prime Minister in 200 years, and it speaks volumes to the benefits of a meritocracy. And of course, we wish that we had a meritocracy in this country. We dream and hope. Then bond yields are improving. Bond yields have been dropping very sharply, as one could imagine and expect in the UK with greater leadership stability. Bond yields have been coming down from their peaks as well in the US, in Germany, Italy, the big government bond markets that we follow. And of course, part of that is hints, including from Janet Yellen, the Treasury Secretary in the States, that maybe there will be some form of reprieve in the quantitative tightening, or potentially the pace of quantitative tightening. There's a mood that monetary policy will shift. Of course, the benefits to these compressing bond yields can be seen quite dramatically in our global portfolios. Investments that were being hammered by the sharp increase in yields are now rising again with a drop in yields. So that's really good. MRB, what could go right? So we begin here. The constructive case for financial asset markets is if the US slowdown proves to be mostly a recalibration to a new, lower but sustained rate of expansion. In other words, no recession in the US. The second thing that could go right is that the euro area energy crisis ends soon. And the third one, that China's COVID zero policy becomes progressively less disruptive. And the writer of this report says that all three of those things are probable. So just a bit of background, it's been a brutal year for multi-asset portfolios, unusually both bonds and equities suffering substantial losses, as well as commodities and signs of cracks in many real estate markets. The only refuge has been US cash. That said, global equities and G7 bonds are now deeply oversold, and the US dollar is extremely overbought, and sentiment is extremely depressed. So I've got some graphs here. It's quite interesting. Three of them, G7 bonds, global equities, US dollar, and we've got the long-term mean, standard deviation bands, and all of them are well off the charts, so incredibly cheap. As a contrarian investor, you would think that is a good signal to start getting bullish. What are the things that could go right? The cost of capital, i.e. short-term, long-term interest rates could come down, but particularly long-term interest rates. And we've seen some stability, as I mentioned earlier, in bond yields over the past week. So what could stabilize the markets is an indication from the Fed that it will pause, even if that means after policy rates reach the current projection of 4.6%, which is still 1.25% higher than where we are now. That would lead to a likely softening in the US dollar, benefiting multi-asset portfolios. According to MRB, we believe the Fed has reached peak hawkishness. Most leading indicators suggest that inflation is rolling over. The second thing, could recession risks get pared back? The global cost of capital has now risen to a level that threatens the weak links of the global economy, increasing the odds of recession for many smaller economies with either housing sector imbalances or economies with government sector imbalances. Investors will need to monitor these vulnerable areas for signs of broader contagion. That said, after a decade of balance sheet restructuring, the crucial US and Euro area household sectors are in solid shape. So we keep mentioning this. It's a theme from MRB and something that we wrote about a week or two back in the weekly market report. US and Euro areas can now withstand higher interest rates than a decade ago, which is generally underappreciated by most investors. There is a case for global recession fears to recede over the next few months as the three legs of the global economy, US, Euro area, and China, begin to firm. So let's look at those three areas just very briefly. First of all, the US monetary conditions, they are still below neutral in the US economy, which means unlikely to trigger a US recession. The US economy is merely downshifting and will remain in a durable expansion. So let's look at Europe or the Euro area. The Euro area energy crisis could soon end. Things could go much better in the Euro area than is currently feared. The war in Ukraine, associated energy crisis, have caused extreme pessimism amongst businesses, consumers, and investors, but it's already in the price. European equities are the cheapest they've been in decades, the cheapest in 40 years versus the US market. And yet, despite all of that, employment conditions and prospects have remained robust. Wage gains and housing solid. Consumer spending has held up. Thus, any positive geopolitical development would likely set the stage for a period of profoundly strong growth. So turning now to cross-border capital, Mike Howe's research, he's talking really about a different form of quantitative easing. It's called yield curve control, which requires less purchasing of bonds, and it's really dependent to a large extent on targeting bond yields at the long end of the curve, most likely. So it doesn't commit to a pre-arranged amount in dollar terms of purchases, but really to use whatever is necessary to keep yields at a certain level. So a lot of it is really bluffing. Sometimes yield curves can be controlled without even expending any amount whatsoever in terms of asset purchases. So it's a much cheaper way because there's potentially far less liquidity going into the market. It means that inflation isn't fueled, but at the same time it suppresses yield rates to keep debt management at a more stable level. So it's quite complicated. I'm going to read out some of the snippets from the cross-border capital research, and it starts like this. Quantitative easing will return, although most likely in the altered guise of yield curve control, YCC. Japan's recent experience shows it can be successful. A key objective of policymakers is to keep interest rates high enough to discourage excess debt, but not so high that existing debts cannot be serviced. At the same time, they need to ensure sufficient market liquidity to prevent financial crises, but not to the extent that it spills over into rising high street inflation in the real economy. So it sounds ideal. A credible YCC policy can be more sustainable for central banks than a pure quantity-based asset purchase program. Lastly, on China, from Macro Strategy Partnerships, China's growth has been the dominant driver of the world economy over the last 30 years, but it is slowing. China's slowdown has been caused by a change in direction of state policy away from reform and towards increased central control. China is important to world GDP. Its contribution to world growth peaked in 2016 at just under 30%, drifting back to 28% in 2018, the last available data. China accounts for 24% of world primary energy consumption, higher even than the US at 16% and the EU at 12%. It consumes 51% of the world's refined copper, produces 53% of world steel. It accounts for 22% of the world's annual savings and 22% of world investment, and has accumulated 26% of world foreign exchange reserves. So the question of why growth has slowed and whether it will continue to do so or not is vitally important. The main factor explaining China's slowdown has been the direction of state policy away from reform and towards increased central control, and the burgeoning misallocation of resources to that end.
Hi, Nick. Thank you very much for an insightful macro overview. I just hope that South Africa isn't so centrally controlled as China is going to be. Locally, Grindrod, we own Grindrod. One big asset manager, 361, they have bought 5.3% of the total number of shares of Grindrod. And another one from Grindrod, they announced that the PIC acquired more shares. They had a 10% interest in Grindrod. They've upped it to 13.6%. Then Raubex, we own Raubex. They expect their HEPS and their earnings per share to be between 10 and 20% higher for the 6 months to the end of August. And they've also, again, Raubex, they've announced that the PIC has acquired shares in the company. At the moment, the PIC owns, it's really shocking, 25% of Raubex is owned by the PIC. It's a lot. The previous percentage was 20%. And then Raynet, they announced that their net asset value per share amounted at the end of June to 31 rand. Used to be 33, not rand, sorry, it was euros, down from 33 euros at the previous quarter. Then Dis-Chem, we hold Dis-Chem. They've been very much in the news lately. They expect the HEPS for the 6 months to the end of August to rise between 43 and 45%, quite a lot. And then statistics. Some statistics are backward looking and some are forward looking. Let's look at those that look backwards. The inflation rate year on year for September was down to 7.5%. It's down from 7.6%. And then the core inflation rate, that went up to 4.7%, down from 4.4%. Sorry, up from 4.4%. And the retail sales year on year in August was up 2%. That 2% is actually down from the previous percentage, which was 9%. That's for July then.